So the Federal Inland Revenue Service is chasing a new window of tax, and this time is what we call the withholding tax and VAT on compensations and benefits and things like that, and rebates. It was a notice to the market and the public by the agency, the tax agency, within the last few days. So we've got in Yomi Olugbenro, who is a partner and West Africa tax leader at Deloitte, Nigeria, is currently in London and is live to us via Skype to give us his understanding of this new chasing withholding tax and VAT on compensations and commissions by the agency. Good morning, Benro. It's good to have you. Thanks very much for spending your time this early morning to discuss this.
Good morning. It's my pleasure. Good to be on your show.
Good. Thank you so much for coming through. So what's your reading of this new focus or addition to tax being paid by the FIRS?
All right. So, well, both things, it's not actually a new item of tax. Withholding tax have been in our legislation for many years. I think it was first introduced in 1977, even though at that particular time it had very limited scope. It was essentially covering rents, dividends, and maybe director's fees. But it's gotten expanded subsequently to include almost all forms of business arrangement and contractual relationships. So commission, interest, royalties, management fee, consultancy fee, all of these have gotten added into item covered by withholding tax for many years. Now, what the Revenue Authority tried to do in the recent public notice is that they've narrowed down on one of the items, particularly commission, that companies pay to their agents, to their brokers, to their distributors. And at best, it appears that there is an expansion to the meaning of what commission entails according to the Revenue Authority. So we're beginning to enter into uncharted territories, if you like. So rebates, discounts, and according to FIRS, whatever type of compensation you pay to your distributors, and irrespective of the mode, you know, whether it is in cash, whether it's in kind, they're saying there are tax consequences. So, and if you look at...
Yomi, a quick one here, and I want us to break it down. So this is a television station, so we charge fees for commercials, commercial breaks, and whatever company pays for placing adverts on this show, for example, and we say, well, we're giving you a commission of, say, 2%, 5%, or 10%, and whatever that comes to, it goes back to the company or the advertising agency. That money that Channels Television is paying to that company, that customer, or the advertising agency here is what the FIRS want to put tax on. Am I correct?
That is correct, but it's in fact extending beyond that, because what you described had always been the general understanding of everyone. When you pay commission to your brokers, to your agent, it attracts withholding tax at 10%. That's always been there. That's very standard. Now, what the Revenue Authority is saying now is that if you have an item that is ordinarily sold for, say 10,000 naira for the sake of argument, and you asked your customer to pay, say, 9,000, and you're offering 1,000 by way of discount or rebate or allowance, FIRS is saying that 1,000 that you have, given as a reduction itself is an item subject to tax. That is true in certain respects, but the word rebate or discount have a very wide and broad meaning in business usage. It has a very wide and broad application in accounting terms. And so different types of allowances and rebate, we attract different kind of accounting treatment and therefore tax treatment. So, but the notice by FIRS was very general. There wasn't any explanation of what type of rebate or what type of discounts they are talking about. It seems at best to be an overgeneralization of that term.
Yomi, the 4-paragraph notice that FIRS, public notice that FIRS issued just about 2 days ago says, putting all companies, particularly those in the fast-moving consumer goods sector, So you're talking about companies on the stock exchange, Dangote Flour, Honeywell Flour, Nigerian breweries, Guinness, Nestle, Cadbury.
That's correct. And all of these companies have different types of trade incentives. And you will expect different kinds of trade incentives as part of trade policies. Companies who want to grow volume, companies want to reward loyalty, companies want to encourage prompt payment. And to drive this kind of performance, there are different kind of incentives. You know, sometimes prices are reduced. Sometimes you have buy one, get one free. Sometimes credit vouchers are given after reaching certain milestone of, of patronage. Sometimes payment that were meant to be 90 days, 60 days, 120 days can be fast forward by offering some kind of incentives or some kind of discount or some kind of allowances. It is this kind of different versions of trade incentive practices that the FIRS is calling attention to, and there's a lot of issues involved. It's a broad spectrum of issues from what is standard and expected to sometimes what is plausible or sometimes what is impractical. And in some cases, if you are not very careful, you may be asking for tax on an item that ideally shouldn't be liable to tax. So I think what businesses just need to do is to realize that taxation is woven into the fabric of business. You know, so whatever you're doing, whether you are buying or selling, whether you are receiving or paying, it's very critical that you call the attention of your advisors to this, because we may be talking of some large volume. So transactions that ordinarily shouldn't have created an additional cost for you could just create an additional exposure if care is not taken.
Yes, we're likely going to be talking about something very big here, Yomi, because this notice from FIRS says even goods in trade. So like you said, it's not just cash. Well, so if I'm a brewing company or whatever, I produce alcohol, non-alcoholic, and perhaps instead of 10 cartons or 100 cartons, they say, well, I'm going to add additional 2 cartons or 3 cartons. Those extra cartons of a soft drink or whatever is now subject to this tax.
Well, that's what FIRS is saying by that notice.
Yes.
But of course, you know that tax authorities are who they are. Their primary objective is to collect as much tax revenue as possible. They are not always right. Public notices are not law. So there are provisions in our extant laws as to what is taxable and what is not taxable. So I'm not surprised if the Revenue Authority make a very sweeping statement in order to catch as many transactions as possible into the tax net. But businesses also have the obligation to review their own businesses within the rules, within the provisions of our tax laws, and ensure that they only pay what is appropriate and what is legitimate. And that's the reason why businesses can't just trivialize issue of taxation. At this particular time where attention is increasingly being focused on taxation, businesses need to also revise different kind of their practices and ensure that they are tax optimized.
Yomi, where is all of this going? And this is the end game. Because if I have a production line, and I'll stick with the fast-moving consumer goods like a brewery, for example, and I've paid my excise duty, I've paid on every bottle, whatever, and all of that, and I've paid my corporate tax and whatever. And then as I'm distributing these goods, this is the tax man, the FIRS coming back and say, look, Bosin, you give an extra 2 cartons or 3 cartons to customer A or B, you need to, or we need to also collect tax on that from you. So where does this go in terms of how we improve trade, customers, prices, costs, whatever?
Well, I think the attention of the market is just being drawn to many existing regulations and practices that maybe we haven't been paying attention to. In fairness to FIRS, withholding tax or VAT or transaction tax, they are not just being newly introduced. So, but what has happened is that maybe a lot of attention is not being placed. So there is a difference between excise and export duty, for example, and different from your own company income tax, and it's different from VAT that is supposed to be charged on your invoices and sales whenever they are applicable. And they are also different from withholding taxes, which ideally it's not supposed to be the tax of the FMCG company you had mentioned. Withholding tax by their nature, it's just an advance payment of income tax from the person who is making, making the income. So if your agent or your distributor is earning some amount of commission or income by dealing with you, there is supposed to be some amount of tax that is due on that. So what the FMCG is supposed to be doing in this particular case is supposed to be deducting taxes on income earned by those agents and by those distributors. So they don't necessarily have to become the tax of those FMCG, even though we all know that the overall consequence is that sometimes the cost of trading is increased whenever tax is involved.
Very, very interesting. How will you, industry players, proceed with this new public notice?
Well, I think we will be engaging the FIRS because at best, I think there's a lot of explanation that still needs to be made as far as this circular is concerned. We're aware of different kind of countries and jurisdictions where discounts, rebates, and commission are subject to tax, just like the way FIRS is trying to do. But in many of those jurisdictions, the rules are very clear. The guidelines are very clear. We know what type of discounts is liable to tax and which one is not liable to tax. So if you talk discount, for example, there are trade discount, there are volume discount, there are cash discount, there are discounts that are applied net of invoice, and you just issue net invoice to the customer, and that's the revenue you record. Whereas there are some discounts that you give maybe several months later after you have recorded your revenue, just to encourage a prompt payment and all of that. So each of these kind of trade incentive policies have different accounting treatments. They are recorded in the books different way, and as you would expect, there are different type of tax consequences. So FIRS shouldn't just make a general sweeping statement because that's just going to cause chaos and commotion in the market. What we should be doing is to be very specific. Let's issue guidelines. Let's make the rules clear. It's painful enough for anyone to pay tax, but it's even more painful when rules are not very clear and we just create different kind of commotion in the market. So for us, we will be engaging the revenue authorities to ensure that guidelines are issued, taxpayers know exactly where their obligations start and where it ends, so that we don't leave everything to an avoidable dispute resolution mechanism.
Yomi Olugbenro, thank you so much. We appreciate your time. It's early morning hour. You need to get into the business of the day. Thank you so much for joining us via Skype from London. Thank you so much.
Thank you very much. Pleasure.
Yomi Olugbenro, a partner and West Africa tax lead at Deloitte, Nigeria. So we had a glitch at the London Stock Exchange this morning, delaying trading on one of the world's largest exchanges, and is causing a bit of ripples across the European markets. Part of the story we're following very closely for our viewers here and in London and around the world. It's an early morning glitch on the London Stock Exchange that was publicly announced, so that delayed trading a little bit. The consequences or the impact of that across the trading board is what we're looking at today, because if you talk about London, then you talk about the global financial center and, of course, the exchange where a number of African companies are listed. So it's a very big story. We'll cross over to our London studios to get Simon Pusey to give us a sense of this. But of course, out of Nigeria is our biggest inflation numbers for the month of July, printing a better numbers as, of course, forecast by some institutions such as Financial Derivatives, looking at food inflation down and headline inflation down to 11.08% year-on-year, than 11.22%, which it printed over a year ago. On a month-on-month basis, Nigeria's inflation was also better, printing 1.01% last month against 1.07% in the month of June. The conversation is already out there. You know how to get that up and running. But let's talk to Simon to get a sense of what this glitch at the London Stock Exchange is all about, even as we hear the marketplace on on Custom Street today is digesting the numbers from GT Bank, one of Nigeria's largest commercial bank, reporting earnings per share 3.50 naira for the first 6 months of this year, better than 3.38 naira, which this lender reported in the same first 6 months of last year. An interim cash dividend of 30 kobo will be paid to the shareholders of GT Bank on September the 11th. How much is the net profit? The company reported 99.133 billion naira, much better than 95.55 billion naira reported in the same period of last year. Other income that this company reported, 28.0 billion naira against 24.74 billion naira reported. Everyone will be looking at these numbers today. The analysts are all poring over it. I will get a market reaction a bit later on the program. What these numbers really mean for the shares of GT Bank as we start today's trading day. So far, it's been a little bit reddish since we started the week. That was on Wednesday, and of course it was on that Wednesday that we all got the announcement of the new FIRS putting everyone on notice, in particular fast-moving consumer goods companies. And then we'll spend the next few days looking at how will this impact on those listed on the Nigerian Stock Exchange. You heard from Yomi Olugbenro there what the new deduction at source means for withholding tax and VAT for commissions and rebates, discounts, whatever you're giving to your customers. The FIRS says now it's time for you to deduct withholding tax and VAT at source and put it in the pocket of the federal government of Nigeria. Let's take a break, everyone. We'll be right back.